In this second video, we are going to talk about receivables. So a receivable occurs when a business sells goods or services to another party on account or credit. What does it mean? Usually when we sell somebody something, what we receive? We receive cash. So our cash is going up. So for example, we debiting cash, what we're saying, the cash is up by $100. But what we want to ask a question, why is somebody giving us $100? So we were credit, for example, so the customer gave us $100 cash. But what if the customer does not have cash? So we are going to say, hey, you can pay us later. So in that case, we have on our customer a claim for $100. That is the claim called account receivable. We're still giving that customer a cake for $100. But either we're going to have this or we're going to have this. So in first case, when a customer gave us $100, we gave the customer cake, we are even. But in the second scenario, the customer say, hey, I don't have the cash today. I will pay you 1 week from today, or 1 month from today, or 2 months from today, or next day, or day next quarter, for example. So what we are saying, we're recording an account receivable in our books. We are saying that this means a one customer owes us $100. This is what a receivable is all about. So, okay. So a receivable is a monetary claim. Monetary means a dollar claim that a customer will pay at any given time in future. That an individual here means a customer will pay us, will give us the dollar. All right. A receivable is a right. Whose right? A right of a business. So you, if you are a business, you're selling something to me on credit, you have a right to receive cash from me at a later date. A creditor is the party who receives a receivable. So basically, you have a claim, you are in possession of a receivable that reflects that I bought something from you and I haven't paid you yet. A debtor is the party to a credit transaction who is obligated to pay later. So we have two parties, creditor and debtor. So a creditor is always a business in this scenario, and a debtor is a customer who is purchasing the product or a service and will pay at a later date to the business. Okay. Account receivable, also called trade receivables, represent the right to receive cash in future from customer for goods, generally collected within 30 to 60 days, reported as current asset. So account receivable is always a current asset and it's represent on the balance sheet. What are uncollectibles? So sometimes you give credit to the people or the business or the customers and they do not return or give you back your money. So that's what we call bad debt expense from a failure to collect from the customer. Okay, so there are two methods of accounting for uncollectible receivable. One is called a direct write-off method and the other is called allowance method. Allowance method is a GAAP method. Direct write-off method is not a GAAP method, but is used in taxation. If you ever take a tax class, especially for a business, you will learn more about direct write-off method. All right. So a direct write-off method is a method of accounting for uncollectible receivable in which company record bad debt expense when a company's account receivable is uncollectible. Uncollectible means you couldn't find the customer. You call the customer, you send an email, you send a fax, you send somebody to collect it, but the customer is not being found. The direct write-off method is used by small non-public businesses or non-public companies because they do not go by a GAAP. They usually use a cash basis of accounting in which you can write off these things. So in a cash basis of accounting, which we discuss in accounting 2301, when you receive a cash, it's an income or revenue, and pay somebody a cash is an expense. Okay. Account receivable written off when the business determined that it will never collect from a specific customer. Once a account receivable is written off, the company stop pursuing the collection. All right. For example, you have an accident and you go to the hospital, means an ambulance carry you to the hospital, and you live there, you stay there for like 2-3 days, and then you came home, and a month later you receive a bill for $10,000. Unfortunately, you do not have a way to pay this $10,000. You may request that I will pay you later. If somehow you are unable to pay after a year or so, the hospital, write off your claim and sold it to some other people for collection purposes. All right. Limitation of direct write-off method is violates matching principle. Matching principle we talked about in accounting is it is not important when you receive the cash. Once you provide the service or the product, it's your revenue, and you have to match so for example, you give me a credit of $100 to purchase the cake, and you gave me the cake, but that cake cost you say $60. So you're going to say debit cost of goods sold to make this cake is $60, and you credit your inventory for $60. So that means you are doing two things. This is a revenue part and this is an expense part. So you are matching, and you are saying that in this transaction I have a revenue $100 and I have a cost of $60. So I make $40 in this transaction. So you have to do both sides in order to fulfill the matching principle. For example, a company records sales revenue in 2017 and related bad debt expense in 2018. This result overstate the income in 2017 and understate the income of 2018. It's overstate the account receivable in 2017. So if you're using a direct write-off method, these things happens. And when you are using an accrual base of accounting that uses matching principle, it basically saves you from making these mistakes. So this method is only acceptable for companies that have a very few uncollectible receivable. The next method we're going to talk about is the allowance method, which basically a GAAP method. Most companies use allowance method to measure bad debts. The allowance method is based on the matching principle, which we discussed earlier. It records bad debt in the same period as the sales revenue. What we do, basically we create a contra asset account called allowance for bad debts that reduces the account receivable to the net realizable value. So what basically we do is we create an account. So when a business is selling things on credit to their customer, they basically make an educated guess what percentage of account receivable we will not be able to collect. Since this is an issue with almost every single business, so this is a very acceptable practice. So for example, suppose you expect to sell this year $100,000 worth of cake, and you are going to sell most of your cake using account receivable, means you will collect the money after you deliver the cake. So when you do that, you say, okay, 1% of my customers are not going to pay. What is the 1% of 100,000? Is 1,000. So basically what you are saying that at the beginning of the year, you are creating a allowance for bad debts that $1,000 I may not be able to collect. Okay. So GAAP requires an estimate be made of bad debt expense at the time of revenue recognition, even though the actual accounts to be written off are unknown at this time. What does it mean? You believe that you may not be able to collect $1,000 out of the $100,000 sales you're going to make, but you do not know whether the amount would be $1,000, less than $1,000, or greater than $1,000. The $1,000 is just an educated guess. The process is executed using the allowance method. The estimate results in an adjusting entry to the contra asset account allowance for doubtful accounts. So what we do, we just say debit bad debt expense for $1,000 and we credit allowance for bad debt. That's also for $1,000. So we are creating this out of a thin air. This is just an estimate that we have. We are saying because this information going to the income statement and this information is going to the balance sheet. We are putting this in the balance sheet right next to account receivable to make sure that our account receivable take into consideration that we may lose $1,000. Okay. Let's continue our discussion. So what we do, we record losses from failure to collect based on company's past collection experience. The one thing that I say, educated guess comes from your past collection experiences. So we set up an account allowance for uncollectible account, just like I show you, and we shows the amount. So for example, balance sheet representation, account receivable is $1,000. In this case, we believe that the allowance for uncollectible account is $900. That means the account receivable we may be able to receive from the customer is not the $10,000, is $9,100. So what we are providing to the readers of the financial statement, that even though as a business I sold $10,000 worth of cake, but I believe I may only be able to collect from my customer $9,100. So the uncollectible expense I have is $900. So writing off uncollectible account method, and allowance is established for the estimated uncollectible account, just like we did right over here. And then instead of recording a debit to bad debt expense, the company records debit to allowance of bad debt. So how we do that? So what we are supposed, we can receive this $900. So what we're going to do, first we created this $1,000. All right. So what we're going to, now we have to write off. So to write off, what we're going to say debit allowance for bad debts, that is $900, and we're going to credit account receivable for $900. So what we are saying that this is my account receivable, this is my allowance account. So in account receivable, I have $10,000. Over here is $1,000 when we credit it. Now I'm writing off, so I am reducing this by 900. So this becomes 9,100, and also debiting this, we're reducing this to $100. So now I have only $100 left in allowance, and we have $9,100 we're going to receive from our customers. Estimating and recording the bad debt allowance, we have already discussed this. You can read these three things, but there is companies estimate based upon experience, industry in which operate, and other variables. So these are the reason you calculate your educated guess, which is also mentioned over here as $900. There are three methods to estimate uncollectible using the allowance method. One is called percentage of sale, which I just show you. This is an example of percentage of sales method. So the percentage of sales, this is a percentage of sales method, the percentage of receivables, and aging of receivables. We're going to discuss these three. In the percentage of sales method, company-based bad debt is a percentage of net credit sales, which we talked about here. Some companies use all sales, not just credit sales. And this method is also called income statement approach. Aging of receivable method is like the percentage of sales receivables method. In the aging method, business group individual account based on how long the receivable has been outstanding. So for example, you have 6 months old account receivable. The chance of recovering or collecting money on a 6 months old account receivable is much less compared to an account receivable which is only 1 month. So we assign probabilities according to, so for example, 0 to 30 days has a 95% of chance, but 6 months old has probably a 50% chance of receiving the cash. In the aging of receivable account, a key measure is determining the speed of collection. And here there are two ratios we're going to talk about. One is account receivable turnover and average collection period are used. So account receivable turnover is net sales revenue divided by average account receivable. How do you calculate the average account receivable? Average account receivable is calculated this way. Average account receivable is used beginning balance of account receivable plus ending balance of account receivable divided by 2. So beginning balance means the balance on January 1st and ending balance is on December 31st. So you take the balance on January. So for example, the balance on January 1st was 5,000 and the balance on ending balance on December 31st was 9,000. So what would be the average balance? 5,000, 9,000 is 14,000 divided by 2 is equal to, so average account receivable is $7,000. Okay. The next one we're going to talk about collection period is equal to, so in this case it would be 365 divided by 7, so average receivable is, you calculated it, so account receivable turnover. So suppose your account receivable turnover, so suppose your net sales is 100,000 and the next item you need is average account receivable, which is 7,000. So 100,000 divided by 7,000 would be, how much is going to be? 14.28. So this number is 14.28. All right. So when you calculating the average collection period, it would become average collection period would be 365 divided by 14.28, which is equal to 25 days, almost 26 days. So what we are saying 26 days means it takes you on average to collect your account receivable in 26 days. Is it good? Is it bad? We have to compare in what industry you are and how your competitor is doing this job. Okay. So this is account receivable turnover ratio that we discussed and the days and receivable. So we're going to stop our video here, and the next video we're going to talk about our inventory topic in the next topic.